education without execution is just entertainment. So
Oh.
execute. So.
All right, welcome to another episode of the Practical Wealth Show. And so today we're going to talk about real estate. We're going to talk about cash flow and preferred equity. What's the difference? Why does it matter between cash flow or cash? And I have my special guest today, Mr. Darin Davis. He's a principal at Club Capital. So let me tell you about Darin before we bring him on board. He is an industry leader, real estate entrepreneur. He's the founder of Capital Club with over 2 decades of industry leadership, which tells me he's been through ups and down markets, which you got to live through, right? He excels in navigating market shifts, guiding investors to exceptional returns. And whether you're a novice or experienced, Darin is ready to share insights on becoming a savvy passive investor in 2024. He's launched his Never Quit initiative, educating young adults on private equity. That's interesting. Okay. And he's in passive cash flow for financial stability. All right. And so I want you to hear tune in. I want you to hear his mottos: education to execution, and start now, start small, but just get started. Join us for this insightful journey. Darin, welcome to the show.
Hello, Curtis. Thank you for having me. I appreciate it.
My pleasure. My pleasure. So tell him what I didn't tell him. And you have a really interesting backstory of overcoming and perseverance. And I know we're going to get into that a little bit as we talk about the show, but tell them, how you got into all this stuff.
Well, the history is, I was living out in San Francisco and dating my current, or my to-be wife. Okay.
Mm-hmm.
And we literally had this epiphany out there, and we're from Texas and we were out in California. We knew someday we'd get married and move back, but a couple things hit us. One, I was doing incredibly well out there. I mean, it was a very robust time in the late 90s. There was a lot of money being made in high tech and software. But man, I got punched in the nose with taxes. Okay. I didn't know. I remember one time having to write a $400,000 check.
Ouch.
Tax. That's what I know. I did double ouch. I said, what the hell? I got to figure something out. And at that same time, I take that punch. And then just a few months later, my father unexpectedly passed away. And it just kind of hit me. I said, you know what? I'm working 5 days a week, 12 hours a day. I'm on a plane Monday through Friday. Yeah, I'm making good money, but am I living a life that I want to live? And I said, no, I'm not, and the wife said, we're not. I said, I know. I said, what do we do? And I kid you not, probably like most other people that got started back then, I'm driving down the highway, going to work from San Francisco to San Jose, long commute every day. But there's a radio program going on, and it's this guy talking about real estate. Now, remember back then we had books on tape, right? And you didn't have a podcast where you could hold it and go back and get it. I mean, you're like scrambling to find a piece of paper in the car so I can write it down, everything.
I remember all that.
Yeah. So, and sure enough, it was Robert Kiyosaki talking Rich Dad Poor Dad. And I just went, whoa, that's it. I mean, I had no idea what I was going to do until that radio program. And it just hit me at the right time, right spot. And so we both put a plan in place, to say, hey, let's exit our current careers. Let's relocate to Texas, where it's fairly friendly business-wise, real estate-wise.
Mm-hmm.
And let's go do this. And we didn't have any kids. We weren't married yet. So we, said, let's go. And I mean, when I say, when you're talking about the opening there, get started, that's what we did. I mean, we jumped in with both feet. We didn't put one toe in the water, think about it. We went because we didn't have jobs. Okay. Right. We decided we're going, and we'd saved up enough money to, hold off for about a year or two. But when you don't have a job, you sure can spend a lot of money when you're not working. Our burn rate was pretty high.
Okay.
Yeah. So we got into it, and then best decision I ever made in my life, hands down, best decision I made in my life. Got into it full time in 2002, and have been doing that ever since. Being an entrepreneur in real estate.
What were you doing? Like single families, apartment buildings, what were you doing?
Yeah, that's a great question. So I probably, like everybody else, I got started with single family homes. And I got up to 5 of them. And after 5 of them, and I said, okay, this is a lot of work. I said, there's guys doing retail centers, and there's guys doing triple net, and there's guys doing apartment buildings. So I just said, I've got to do something different. So I did everything from single family home to lot entitlement, land development.
Okay.
A few spec homes, I kept raising the bar each time. And then in 2004, I met a guy, and he was doing Class B retail centers. And he was kind enough to let me kind of, run alongside him. And I raised capital, just friends and family. And went in and we did 13 retail centers in a period of, 4 years.
Mm-hmm.
Yeah. And did very well on them. And all we did, I mean, it wasn't earth shattering, but we re-tenanted we got the old bad tenants out, good ones in, re-upped everybody's leases. And you hear we put a lot of lipstick on it. We painted the parking lot, painted the building, took care of a lot of deferred maintenance, got them back on the market, and usually sold them within 2.5 years. So did that and was incredibly successful at that. And that's where I learned to do syndication. So I didn't even know what syndication was when I met this guy, and I kind of looked at him going, I don't want to be a mob boss. I just want to try to figure out how to do real estate, but I didn't even know what the word syndication was, but he taught me syndication. And then if you go back, 2008, 9, and 10, syndication became very popular. And with the Jobs Act through President Obama in 2012, then you had the whole crowdfunding and syndication, and it became a big opportunity for everybody, which has been fantastic.
Okay. All right. And so let's go to the topic then. Cash or cash flow?
Yeah.
Why does it matter?
Yeah. Okay. I don't know how old you are, but let's just say we both have a couple decades behind us. Okay.
Yes.
Yeah. How many times did we hear cash is king? Cash is king. You've been hearing it since you were a little kid. Okay.
Yeah. Yes.
And I realized, and I was saying, yeah, I get it. But I realized probably 3 or 4 years ago, I go, cash is not king. Cash flow is king.
Yes.
Because the inflation bug hit me hard when I started looking around going, holy cow, we're not at 5 and 6% inflation. We're truly at like 12, 14, 15. All right. And for you to keep up with inflation and just your standard of living, you had to be generating that cash on cash. All right.
Right.
Cash just sitting there. And we all see the numbers, since, I don't know, I'm making this up. And since 1920, the value of the dollar is down 95%, right. So, and it's not going to change. I mean, we're as long as the United States is the default money system, and we're going to continue to print money. I don't see that changing anytime soon. We're going to have inflation, and you've got to be looking for cash flow and some liquidity and some cash flow to keep up with just the demand of building your wealth and building, kind of your safety net as you go forward. So I preach cash flow. I go, yeah, if you got a lot of cash, great, sit on it. But I wouldn't be sitting on 100% cash right now.
No, I mean, until you find something to do with it, right? Because if you have like Buffett, I was watching the Berkshire Hathaway thing last weekend. It's not really just sitting on, because he's earning 5% in treasuries, but he's looking for an asset that he feels worthy to risk his capital in. But I think as smaller people, we have a saying, Darin, you can't eat equity. Okay. And
I got tables full of equity. Okay.
Right. And so you need cash flow to live. Cash flow allows you to go to the beach and stay at the beach, Yeah. And so that's powerful. A lot of people don't know. what I find when working with clients, they're by default, they're taught to invest for capital gains, you know, and invest for growth. And I don't think cash flow, they give it lip service, but if I look at what they're doing with their money when it hits their personal economy, you look at their they're not trying to do that. And one of the reasons I love, I'm excited to have you on is just to get people, look, you got to change your thought process. What are you doing to because you don't want to retire. We say you want to become financially free, right?
Correct.
Which is a capability. Okay. Retirement age, you want to have passive income greater than your expenses.
Well, and I'm at the age right now where I'm really thinking of what the next 5 years will do for me to set me up for really my fun time, super fun.
Yeah.
I mean, I have a lot of fun now, but I want to have even more fun because, my kids are both in college now, and I've got an opportunity to do a lot of things that I haven't been able to do in the last 10, 12, 15 years.
Right.
And I know that I can only get there by setting up multiple streams of cash flow. I mean, I am so laser focused on that. And a little bit later, we're going to talk about an opportunity, that the market has provided for us, but it's it's one of the things where everybody thinks the market is just in turmoil, there's a lot of things that are uncomfortable, especially in the multifamily refinance space, but there's also a lot of opportunities out there.
Wow, because I've not been hearing that, so I'm excited to hear about.
I can't wait to tell you.
Yeah. Look, tell me about your thought process. So a lot of people don't know even how to thinking about building a plan to get themselves out of the rat race. Tell me your thought process. Because what I always tell our clients, or our listeners, success leaves clues, and I want to kind of get into your mind of stuff that they could put into their mind to get them ready for you, or just get them ready with their own personal economy and how to move in that direction.
Well, I tell you the way I approach it for me personally, and I tell new investors, I say this all the time, okay, or I share my opinion and experience, but the way I approach it personally is I have buckets of money, okay, and for example, I have 2 triple net deals in real estate, where I don't do any of the taxes, insurance, maintenance, anything like that. And I get a check. I love those things. Love them. Okay. And they just keep clicking all the time. I've got good tenants in there. I also have some developments, apartments, and those are my kind of big home runs. Mm-hmm. That maybe, when we perform, of course, I'm the last guy to get paid. I mean, mm-hmm. The bank gets paid, my investors get paid, and if we're profitable, I get paid. So it's on me to make that thing work. So I have that. And then I have my smaller things. I probably have, now that I think about it, I probably have 5 loans out that are paying me anywhere between 8 and 12%. Secured by, all of them are secured by second liens where the loan to value is really low, but I've got a second on it on that. So I have that. And then I have invested in, I think, 7 different deals that provide quarterly cash flow. Mm-hmm. Friends of mine. So I have one guy that does hospitality. I have another guy that does car washes. I have another guy that does oil and gas. So I'm always looking for what's the right investment vehicle. And when I see one of them really starting to perform and I understand it a lot better, then I'll start taking from one bucket and adding to that bucket. But I'm probably a little too much on deploying my cash everywhere. But, a lot of people say, hey, you need 5 or 10% in cash just sitting there for a rainy day. I'm at that 10% because I like to get my money out and get it working constantly.
Yeah, I love that. I think one of the things I want to point out, because this stuff you just verify something that we always teach our clients and listeners, is like we talk about the 3 rules of investing. So invest in what you know, or invest in knowing. Okay.
I like that. Yeah, right?
Invest in what you can control or influence the outcome of what you do, and don't chase return, right? Mm-hmm. And so those are, and so so I'm listening for that when I talk to people, right? So I was, okay, I'm on the right track here, because this is, because invest in knowing is also, I think you talk about this later, is the operator, right? Is
Yeah.
knowing,
Oh, 100%. Yeah.
how to
No.
do due diligence and all that kind of stuff.
Well, and where I am in my life cycle now, I've deployed money out to people, and they're people I know. I trust these operators.
Yeah.
I mean, I it's not like I just found them on the street. So, but I'm now taking that kind of broader asset base, and I'm starting to pull it in where on the assets that I have control over, because now I'm getting to a point where this next 5-10 years, I don't want to be counting on somebody else for my fun. Okay. I know what I know, and I know what I can do. And like, I like what you said, know what just know what you're doing. Either you're taking a lot of risk, or know what you're investing in, one or the other. So,
and the more you know, the less risky it is, because you are smarter.
Yep.
And so as your knowledge goes up, your risk comes down.
Yep. Yeah. Absolutely.
So tell me where you want to go next. I'm listening. I'm just like, y'all listen. I don't have any notes. He's fascinating. So I'm just letting if we're having a beer, this is what we'd be talking about.
I kind of want to tell this story because I think it is so important. And I'm going to be really brief, but it's, you've all heard the stories about the two brothers. Okay. There's a story about one brother does this and one brother does this, and this one financially free and this one's in debt, just by the little things they do in this cycle or this path they go down. And you see all the stories about, hey, if you start when you're 25 versus starting when you're 45, here's the difference that makes. But here's the quick story. We had a life event in our family. But my wife and I, at the time when we left our jobs, and decided to jump into this, we were just fascinated with entrepreneurship and control and real estate and cash flow. We were just that we get it. So we spent 10 years and we got in a real good position. And then unfortunate for our family and her, she was diagnosed with cancer. And so at that point, we had to make some decisions. We had young children, and I can tell you right now that if we had not spent the last, it was 10 years, but just say 3 or 4, 5, whatever, and built up that cash flow for I call it retirement or freedom or whatever you want to call it, just so that we had it coming in, we 100% without doubt, we would have been wiped out, because when she got sick, I had to pivot away from work and towards her and the 2 young children.
Right.
Well, I'll give you the little story. As she was being treated for cancer, there was another couple that was kind of on the same schedule we were. Every week you go in and you do all this. And I remember we kind of, nobody wants to really talk when you're in there, but we kind of befriended them and talked. Both of these guys were employees, she and her husband. The wife had cancer as well. Both of them ended up getting let go of their jobs, and both of them did not have another source of income or cash flow or anything. And I literally saw their lives just crater right there. I mean, I had front row seat sitting there looking at it going, this is the saddest thing I've seen. Now, it's just bad, period.
Right.
But you're going to have a life event. And if you're not prepared for it, it could wipe you out. And we just got fortunate. Now, she did pass. I still had to raise my 2 kids. So there was about an 8-year window there that I did not work full time, but we had built enough assets that cash flow kept coming in. And it's allowed me to sit here with you today,
right,
and tell these stories, this conversation, and actually grow the business now. And it's been, I just can't tell people enough, just prepare for life, because life comes at you, maybe nothing, and count your blessings or something, and you're prepared, and that it could change your life dramatically by just being prepared.
Yeah. I mean, amen. I mean, because it's like, I tell people, financial planning is not about investing. It's about preparation for stuff happening, first, right? You got to play defense and cash flow.
Build that foundation. Yeah.
You can't build a house on rock, right? On foundation, not on speculation or gambling.
Yeah. I mean, I'll end it with this, but I'll tell people, I mean, these are real numbers. 10% of the people that are going to listen to this or watch this podcast, have gone through a life event like I have. Maybe Curtis and I didn't ask you. Maybe you have too. There's no telling. We all have one at some point. But by the time you're 60 years old, 50% of us will have gone through a life event. All right. So now you're flipping a coin. All right. And if you're not ready for it, and the worst thing, think about this, if you're 60, 65 years old and you get wiped out, good luck recovering for that.
Right.
So that's some scary numbers, and you start thinking about it. And I'm getting excited here because I just want people to really think hard about, you hope it never happens, but my guy, you're the family hero if it does, or if it doesn't. You're the one that keeps the family together. Whoever, the mother, the father, whoever, just take it serious.
Yes, take it serious. I mean, so I have a couple of things, right? And you just have to be resilient, and you got to be prepared. Like, it's scary, And even with us, we're like, all right, I feel like I've got to build a bigger foundation where this happens. I have two, one just graduated college, one in college, and a 12-year-old, right? So, and I'm 60, all right? So, it's like, in my mind, it's like 3 weddings. I got 3 daughters, right? 3 weddings, and I got to work out. I got to be here.
Yes, you do. Yeah. I thought I was an old dad. You're an older dad than me.
Yes. It's no joke.
So yeah. Well, I just want to share that with you. But why don't we pivot to a little bit about the market and kind of share with you what we're doing on that. So, my background and for the last decade has been multifamily. Actually, last 12, 13 years. Love multifamily. Love everything about it. And we stay primarily focused in Texas and Florida because of just the business climate. We've got a lot of net migration here, a lot of jobs, corporate relocations. We're super fortunate that we have what we have here. And it really bodes well for multifamily. But as most people know, this market that we're in now, we've had kind of this Armageddon of, high interest rates, lower leverage, a little surplus of product, rent compression. So you got all these numbers moving around, and none of them are moving in the right direction for investing. All right. So what's happened is these multifamily developers, who we are a private equity group, and we fund these developers with LP equity. These guys took out these loans 3 or 4 years ago, and they were floating rate construction loans at like 3.5%. Well, they've drawn down most of that money through construction over the last 2 or 3 years, and that rate is now 8%. All right. So and the rents that they pro forma'd 3 and 4 years ago, say it was $2 a foot, now it's $1.65 a foot because there was a supply, and it's the perfect storm in an unpopular way. But what's happened is these developers need what we call rescue capital or a lifeline, and it's called preferred equity. Okay. And so you have, if most people understand kind of how equity works, you have your senior debt, which is your bank loan, and then you have your common equity, and then it's usually, let's just say, 70-30, okay? 70% bank debt, 30% equity. And that's been the way we've operated for the last, 12, 13, 14 years. Well, now the banks are taking that leverage, which used to be 70, 75%, and they're bringing that down to like 55 or 60%. And interest rates are going up. Well, there's this gap that developers are needing filled with preferred equity. So we're coming in and providing this preferred equity, and it sits in front of the common equity, but just behind the senior debt. And it's a fixed rate return. And so you're not getting the upside of, what you would on common equity when the property sells, but you're getting your money paid to you before the common equity in full. So you'll get your rate of return, plus you'll get your basis back, your capital investment back before the common equity gets anything. So you have this safety net behind you. And that safety net is fairly significant. It's going to be, 20% of the capital in the deal, 20, 25%. You're going to be 10 or 15, and the bank's going to be the rest.
Okay.
but there are $600 billion of multifamily loans maturing 24, 25, and 26. And it is our belief that not much is going to change over the next 12 to 18 to 24 months. We think this is going to be another, 2 years before we see the market pivoting where demand is greater than supply. Interest rates are more normalized. Supply chain stuff is all done. Pricing, like transformers, concrete, all that stuff is super high right now. But there's an opportunity for preferred equity to come in short term, typically 2 years, typically, let's say 12% annualized return paid out quarterly. Okay. And so you're in and you're out and you're not in there long term. And what I really, really like about it is two things. One, for investors that are looking to get into commercial real estate, primarily multifamily, you get to, for a very safe, secure position, you get to get in the deal and it's short term, there's a return, and you get to see how the operator, the sponsor, performs. Okay. How do they communicate? How do they report? What's their business plan? Part two of this is that every deal that we're doing for this preferred equity, we are underwriting it as if we were going to own it, because quite frankly, I want to own it. And here's why. Here's how and why. If you're going to pay me to sit in your deal and watch that deal perform, I've got a front row seat. I mean, I got courtside seats and I get to watch everything: property management, asset management, everything. Mm-hmm. Mm-hmm. And I'm sitting there ready to go into the deal to the sponsor. And so we're getting the ability to get a first shot at that deal, and we're getting paid to look at it. And we're in a safe, secure position, and we're only in it for like 2 years. Now, we don't have to go forward with it. Right. We can get our money and move on. And that very well is going to happen probably more often than not. But I love the fact that I'm in a very safe position in a state with a product that is growth, pro business. Mm-hmm. And we're going to be doing that position for probably the next 2 years. And we're already starting to see some opportunities that we didn't see 6 months ago just by doing this preferred equity.
Let me ask you. So the cash flow is coming from you. All right. So I'm looking at the my half glass half empty eye, but you're making cash flow because there are rents coming in and you're getting money from the rents. Is that where your quarterly payments are coming from?
Well, let me clarify. There's two things. That's half of the answer. Yes. Okay. So when we go into this, typically these properties are not occupied. They're right at the end of construction, or they're just starting their lease up. So, right. Okay. Yep. So what happens is that through our underwriting and valuation, the developer will have to escrow like 1 year of interest payments with us. Okay. So we want to make sure that we're getting money. So from an underwriting, we make sure that they can do that, and we get that money escrowed up front. So it covers that first 6 months, 12 months until those guys start leasing and get it up to 70%, 80%, 85, 90. And that's where the cash flow will start coming out. But what's going to happen is our investment is coterminous with the senior debt or the bank loan. Right. When that loan matures, we get paid. Okay. So when the bank loan goes away, so does ours. So we are absolutely out at the same time the bank is out. And we have all of that common equity behind us. So, I mean, on a bad day, could the common equity be diluted some? Maybe. Is the sponsor going to be diluted? Probably, because they're the very last one to get paid. Right. Right. So we feel like we're in a really good position there. And that cash flow comes from, interest reserves escrowed up front. And then in the second year, it's going to be more on the cash flow from the property. That's correct.
And then when they drive up let's say everything works out, they drive up the value of the property through getting it performing, then your opportunity, they want to cash out with the bank and get new money, pay their investors, and move on. And is that where the opportunity is lying for you there?
Yeah, that's okay. That's the business plan. So,
Okay.
step one, let's get a nice investment that pays us quarterly. Okay.
Okay.
Short term, 2 years cash flow secure. We like that. Part two of the business plan is we want to be there when that loan does mature, and we want to either come in and acquire that asset at that time. Yeah, so we would either allow our pref equity investors to go with us, and some of them they go with us, and some say no, I'm out, and we say okay, that's the deal. But we would want to go acquire that asset, put new debt on it, hold it for a period of time, maybe 5 years, give or take, maybe 7 until we do a refi, and then pull some cash out and then hold it again. I tell you, we sold all of our assets up through 2021, and I'm glad we did because we did really well on all of them.
Mm-hmm.
But it is hard. It is hard getting a good asset, and once you get one, we're going to be more of a long-term hold. You'll see us holding this closer to 7 years.
Okay.
Yeah, because it's hard to replace it. When you get a real good asset, it is hard to find another one just like it. So, you'll see us going more of a cash flow model versus a sell model. And the developers, they're called merchant builders.
Mm-hmm.
Their business model is not to hold for cash flow. Their business model is to flip that money every 4 years, build it, stabilize it, get out of it, do it again, do it again, do it again. So that's why those guys want to get out as fast as they can to recycle their money to go do another deal.
So I love that. I mean, so I see how you're saying a once in a decade opportunity of, because I've never heard of, most people I know have never heard of preferred equity. And that's a really unique niche.
Yeah. Well, nobody needed it for the last 12, 13 years. I mean, money was so cheap, and it was funny because I've heard of it because I've been doing this for 20 years, but it's been interesting. I've got some investors that I've known a decade plus, and they've never heard of it either. And, people have maybe heard of mezz debt, mezzanine debt, a second lien. It acts like a second lien, but it's not liened on the property. But it's just it's in the capital stack. It's senior debt, pref equity, then common. And, that pref equities, it gets fully recapitalized out to the investors with that return before the common equity sees any money.
What happens if, so everybody's putting pressure on PAL to lower rates? It's funny because there's two sides of rates, right? So rates, it's savers, it's helping. I do insurance. Our dividends are up, right? And the insurance companies are locking in these, long-term bonds and stuff at 4 or 5%, and it helps. But on the other side, that's somebody else's cost of money. So all of a sudden, with higher rates, the money's more expensive, which is creating the opportunity. What happens if rates start to tick downward? And do you see that economically?
Yeah. So, I think the preferred equity has about a 2-year window.
Okay.
So if you start moving interest rates today, I think it was projected in January of this year that, 75 basis points throughout the end of the year. And it'll all be backloaded to the back 6 months. Well, that's great. Okay. But we still have valuations are down. Okay. That interest supplies up. Okay. We overbuilt in 21, 22, 23. And we'll catch up. It'll take about 2 years to catch up. But the rates, if they move 100 basis points, might start to move the needle. You move 200 basis points, now we're talking. And I think that, along with the supply, that's where I think it's going to be 2 years before things start settling. Now, you may or may not have been in this space, but you're old enough to know this. In 2007, 8, and 9, when the great financial crisis happened, I mean, construction went to nothing. Okay. I mean, we just
remember that. I was doing mortgages then. So I saw
you were doing mortgage. Yeah.
I was still doing this, but I had mortgages on, and I was a certified mortgage planner or whatever. But I had a front row seat to, one day this company was open, next day it was closed.
I was there too. But I guess the point being is that when 2010, 11, and 12, when we started coming out of that dip,
Yep.
I didn't invest enough money. I kind of sat on the sidelines. I put a little in. Every asset that I bought, I bought 3 assets between 2010, 11, and 12. All right. I have 2 of the 3 still, and they've been my 3 best performers because I bought them when I was at the bottom of that trough, kind of in the deep part of it. And I don't think today is exactly like 2008, 9, and 10, but we're going to experience this fall off of new construction. Demand's going to outstrip supply in about 2 more years. And the people that prepare to get into multifamily in 2026 is the kind of the golden year.
Yeah.
Those are the people, 26, 27, 28. You're going to get that hockey stick effect again. And you're going to see, because, we're still getting positive net migration here. Jobs are still coming here, and supply is starting to taper off. And so there's going to be another opportunity. And getting into that
California is going to keep
I know
people away, right?
Yeah,
So
I this time I know a lot more than I did, 12, 13 years ago. And but I'm prepared to and this is not rolling the dice at all. This is a lot of data, a lot of work.
Yeah.
We're preparing, and I'm preparing to go in 2026, 27 and really start working on some significant acquisitions, if not 25.
The words I want to point out is prepare. Okay. Preparing, right? Think long range. We always talk to our clients about and prepare, and then focus on cash flow. That is brilliant. Anything you want to add to that, or any other topic you want to go that you think would
well, I think a lot of people are sitting on their hands, and I understand. I had a guy the other day say, "Man, aren't you worried about the market?" And I just kind of smiled. I said, "This is my 3rd rodeo." I said, I'm old enough to know that, the first one I was super nervous. Second one, I was really worried. The 2 that I go today, I'm just going to sit back and wait. And my opportunity is going to come in, 12, 24, 36 months. I would say this: there are ways to safely and securely be in the market versus just sitting on the sideline. Mm-hmm. And I would say this to newer investors. If you've got a couple $100,000 and you want to deploy that into some commercial real estate, passively LP, don't put all 200 with one sponsor. Okay. Break that up into, at least 3, if not 4 investments, and watch how the operators work. Like I told you earlier, I said, look, I got money with seven friends. Okay.
Right.
And I'm watching what they do and how they do it. And I'm going to start reining that in over the next couple of years and just really do the stuff I can do. But I know I don't want to be 100% in real estate, I mean, multifamily. And, that's why I've got some oil and gas, and that's why some hospitality in the hotel side. It's real estate, but it's a little bit different business model. But I say it I think you said it in the intro. I mean, I am get started, start small, get going. And I think the one thing that I used to say a lot to people, I said, education without execution is just entertainment. So execute. So a lot of people will read 100 books and never pull the trigger.
I know. That's the one thing I'm trying to do is like, y'all got to do something. I do a little mastermind call. Listen, what'd you do this week? What did you do to, what'd you read? What did you try to execute? What are you doing to make new money? And I'm always trying to beat them over the head with do something, start something, try something.
Yeah. You never know. I mean, and there's no doubt about it. The best education I got, hands down, was when I put my own money in a deal, because if it did well, I know that I did something right. I try to learn from that. But early on in my investing years, they didn't all do well, and they were painful. Right. Boy, I learned what to do or what not to do, but I learned, and I was able to carry that knowledge forward. And like I said earlier, I mean, best decision I ever made was getting into the space that I'm in today.
I love it. Yeah, I've always been taught that activity produces knowledge. Knowledge does not produce activity. And so, Emerson said, if you want the power, you have to do the thing. And and you get good judgment from having bad judgment first, and
Yeah.
you got to try. So that is brilliant. So how can they find out more about what you're up to, looking at, and maybe getting in that space? What would you have them, find out
Yeah.
more about you? How would they do
Yeah.
that?
It is, it's called clubcapital.co/practical. Clubcapital.co/practical. And on that is, there's a couple documents on there. And I think one of them that is real important is we kind of have a pref equity 101.
Mm-hmm.
And it's a definition of what it is and how it works and how it fits in the capital stack and the security and safety and cash flow and all the stuff we've talked about. So that's a good one. And our contact information's on there to do that. But that's what we're really focusing on with our investors now, getting them set up for 12 to 24 months from now, but getting paid today and not sitting on the sideline with just cash for a year or two, because we're paying. I think the two current offerings we have right now, I think both of them, one's 12. Yeah, they're both at least 12%, and that's not bad, especially when you're looking at it's a contract, it's a fixed rate, a fixed time frame. And you've got that, that safety net.
Awesome. That's more of the, with cash flow secured by a real asset.
Correct.
That's most people don't get that. People say, "Oh, I have my mutual fund and hit 12%." Yeah, but that's just a capital gain, and you don't really realize that unless you sell the shares. You're not getting a check every quarter, right? And that's we try to encourage our people to buy something that sends you a check, because you have to train your money early on to send you a check. Like, we wait till 65. You need to learn how to earn money now off of your stuff you buy. So I think that's fantastic.
Yeah.
And we're secured by a property in a position. I think guys, what you got to do is don't be lazy. You got to educate yourself and ask questions. But can I ask this? I know they probably, sounds like they do, because I check out the site, but should they be accredited investors?
That's a good question. We prefer, and we're pretty true to this. There's some occasions or some special circumstances, but we do prefer to work with accredited investors.
Mm-hmm.
And thank you for asking that question, because and sometimes it's a little difficult with newer investors, but I would say we're 99% accredited investors. So yeah, that's a good point.
Because it's great, because you can't put your last dollar and say, 12%, and you can't give them your last 100,000, or your only 100,000, or only 50,000. Like, you got to have.
I wouldn't take that money.
Yeah.
I don't. Yeah. I've had younger guys, people, male, female, say, "Well, I've got this 50,000," and I'm saying, "Okay." And they said, "Well, I can't lose it. It's my last 50,000. I'm going to let you. I'm not touching you."
Right. Exactly. Yeah.
You keep that money and grow it to 200.
That means you're not liquid. You haven't saved enough, and you need, one of the things that we preach is 6 to 12 months of liquidity, and I want 3 to 6 of that, like, liquid, like you don't touch. And then above a certain point, now you can begin to look at other stuff. A lot of times, Darin, I say, look, you need to invest and grow your business or your revenue so that you're a credit investor. That's why, I tell people, if you're in business, the first thing you do is get your income over 300 grand, 200 or 300 grand, and save money. Now you're ready to deploy yourself into more passive opportunities. But I think you have to start with active, then become passive. And
I agree. Yeah. And you know what? It's a commitment. If you're going to keep a job and do this, I mean, you're going to be burning the candle at both ends, but it's so worth it. I mean, like I said, from my story earlier, I can't even imagine if we hadn't have done what we did, where I would be or where my kids would be right now. It would be a completely different story. And not a real positive one. I don't think.
Yeah. I'm so glad it it was still tragic, but it worked out because you were prepared. I think that because it is hard, but it takes some discipline. But everything that you've become successful at this, if you're listening, took discipline, hard work, focus. right? And so I don't know why people don't do that with their money. They just think they work hard, they focus. You're good at piano, you're good at any sport, you're good at golf. You worked hard. You hit 1,000 shots a day. You practice, drill, rehearse, you focus, and you want to make money where you're expert, and you want to give it to somebody you never met, or you just want to not think about it, and even and some people make them same mistake with syndications. They don't know how to vet good operators.
Yeah. And you know what? I think, just speaking of that, on the operators, I think on that landing page, we have a top 10 questions to ask an operator. And if we don't, I'll make sure it gets on there. Yeah. So that, because I think, we don't know what to ask or younger investors, meaning younger in experience.
Yeah.
And because you just don't know until you know. But we try to, and it's pretty straightforward stuff. It's not real complicated. It's information that you could ask and get an answer, and you would understand if it's good or bad. So for you, we'll make sure that make sure the Pref 101, Preferred Equity 101, and the top 10 questions, sponsored questions, will be available.
Yes. Oh, here it is. Let me see. Just hit it real quick. I got one on the site. So if it's in there, so this is a great site. So we'll put it in the show notes, guys. And I think that's it. You want to learn what to ask. Due diligence is investing in knowing. Okay, is the first step. And a lot of people don't know. I said you don't even know. It's like, whatever you want to ask me, any question you want to know about nuclear physics. I mean, what do you and so for investing, it might as well be that, because the only thing they look at it, what's the rate of return, and it's more to it than that. And you got to ask better questions than that. You have to be a little bit more sophisticated. So, Darin, awesome.
We've made mistakes, but we make them right. So you're not going to be 100% all the time,
right?
But man, just get with the sponsors, and that's why I said break your money up and go to 3 or 4 different people, because I've seen completely different operating styles, and one may work for you and one may not. So I think getting that trusted sponsor is a big deal. So
that's awesome. Darin, anything I didn't ask you that I should ask you that you want to get out?
No, this has been good. I think the main thing and I'm glad we talked about it, the two main things is, one, just you and I, it's ingrained in our souls about cash flow. Anybody listening to this is just, I can't stress it enough. And two, the market has provided us an opportunity with this pref equity. If you just keep pushing and keep looking and keep moving forward, you'll find opportunities, whether it's pref equity or something else. There's going to start being some real deals out there on some assets, because there's a lot of loans maturing, especially at the regional bank level, not, big Fannie and Freddie and HUD loans, but, your local banks, they've got a lot of real estate that's starting to come due in the next, 12, 24 months. And I think there's going to be a lot of deals out there. So keep, if you're interested in doing that, find somebody locally or regionally that, if you've got enough time or bandwidth or knowledge, there's going to be a lot of opportunity. Like I said, that hockey stick that we saw back in 8, 9, 10, we're going to see that again in another year or two. Just be prepared, because you can have a wonderful opportunity to make some really good money, good cash flow.
That's where the opportunities are in bad times. That's where millionaires are made. And so don't run from that. You need to just have dry powder, save money.
Run into it. Yeah, from it, into it.
Into it. It's educate yourself so you know what you're looking at, and then go have at it. Yeah, that is that. Look, we're going to close with that, because that was brilliant.
Okay, no, I appreciate it. No, that's the main thing. It's take advantage of the opportunity. It's there.
Yep. And so we're going to put Darin's information in the show notes. So go there and check out his stuff, download the report. And I think this will, this is a good thing to research. Darin, I'm so happy that you shared your insights. I like to see the insight of, how you grew your career. And one of the things that, even if you're not ready to invest with him, you can borrow a lot of pages from his playbook in terms of his mindset, working on his skill set, because it's all mindset, skill set, network. That's your number one investment. Your number one asset is you, right? And what do you invest in? Mindset, skill set, network. And I think your life story showed those three things.
And on our website, we've got a lot of educational information. Right? We do, a couple blogs a month or more, maybe one a week. And it's all informational education, market conditions, what we're doing, why we're doing it. So there's a lot of good info out there.
All right, perfect. Darin,
Thanks,
thank you so much.
Appreciate
Go out there. Yeah, thank you. And go out there and listen, share. If you like it, share it with a friend that you think needs to hear this. And Darin, have a great day.
Hey, thanks, Curtis. We'll talk to you soon.
All right,
bye-bye.
Are you ready to take control of your financial future? Hi there. I'm Curtis May, and I'm here to help you achieve your financial goals. Do you want to be the customer bank, or would you like to be the bank? Subscribe to our channel for regular updates, valuable insights from experts in different fields. The name of the game, guys, is cash flow. Okay. You can't eat equity. And our goal is to help you build, we call it being a cash flownaire, which is passive income twice your expenses outside of Wall Street, where possible, right? It is quite possible. And so if you're interested in learning more about our services, here is what I challenge you to do, or I invite you to do, I won't say challenge, is to take our financial freedom quiz. See where you are, okay? Don't wait any longer to take control of your financial future. Let's begin this journey together.